I mean, we all know Amazon, right? That 2-day shipping, the massive selection, those low prices. The company is an absolute machine built to make us, the customers, happy. But there's this huge debate going on that asks a really critical question. Has all of that success, all of that convenience, come at the expense of competition itself? Today, we're going to unpack that exact tension.
Okay, so to really get Amazon, you have to start with the philosophy that kicked this whole thing off. Jeff Bezos has famously said the company's number one principle is customer obsession. And this idea? It's the engine behind everything we know and love, from Prime delivery to one-click everything. It's all about starting with what you, the customer, want, and then working backwards. And, it's been incredibly successful.
So, here's how we're going to break it all down. First, we'll dive into Amazon's core philosophy. Then, we'll explore the weird paradox it creates. After that, we're going to look at the big legal shift that kind of paved the way for its rise, check out the playbook it allegedly uses to dominate, and finally, ask the big question: what's next for competition?
All right, first up, let's talk about the part of the story we're all familiar with. Amazon's relentless, nonstop drive to innovate and just get bigger. And what's so wild is that this isn't some new strategy. This was the plan from day one, literally. In his 1997 letter to shareholders, Bezos laid out this day one philosophy. And the core idea was really simple. Forget about making a profit in the short term. Instead, the goal was to invest like crazy to build an enduring franchise. That meant growth, customers, and infrastructure were way more important than anything else, even if it meant losing money for years on end. Okay, and it's that relentless, almost obsessive focus on growth that brings us right to the core of this whole debate. This leads us to a really fascinating idea first laid out in the Yale Law Journal. It's called Amazon's Antitrust Paradox, and it asks a simple but kind of profound question. If a company is giving us everything we want, lower prices, faster delivery, how on earth can that possibly be a bad thing? It really pits our immediate happiness as shoppers against the long-term health of the entire market. So you can really see the two sides of the coin here, can't you? On one side, we get these amazing, tangible benefits right now. I mean, who doesn't love a good deal delivered tomorrow? But on the other side are these invisible, long-term costs. When rivals get pushed out of business, do our choices eventually shrink? Does innovation slow down because new companies just can't get a foothold? So to really wrap our heads around how we got here, we need to jump in a time machine for a second. Because the rules of competition, they didn't always work this way. See, the rule book for what counts as fair competition, it has completely changed. Back in the day, through the 1960s, antitrust law was all about market structure. The basic idea was that one company having too much power was just inherently bad for competition. Bigness itself was a problem. But then, starting in the 70s, this Chicago School of Economics came along and totally shifted the focus. They argued that the only thing that really matters is consumer welfare, which in practice has pretty much boiled down to one single thing. Are prices low for us? Right now. And this one single shift, it basically rolled out the red carpet for a company like Amazon. As long as Amazon keeps prices low, things that might have been huge red flags in the past, like, say, selling products at a loss to crush a rival, are now incredibly difficult to challenge in court. Okay, so that's the theory. But what does this look like in the real world? Let's dig into a couple of key examples that critics often point to. So let me tell you a story. It's about a company called Quidsi. You probably knew them as Diapers.com. Back in the late 2000s, they were on fire. A super innovative, fast-growing online shop for baby stuff. They were doing so well, in fact, that Amazon came knocking and made an offer to buy them. But Quidsi said no. They wanted to stay independent. And this is where that day one, growth at all costs mindset gets weaponized. In response to being turned down, Amazon launched its own service, Amazon Mom, and just slashed its diaper prices by up to 30%. According to reports, the company was prepared to lose $100 million in just a single month to win that market. I mean, how can a startup possibly compete with that? They just couldn't bleed money like Amazon could. They were forced back to the negotiating table and ended up selling to Amazon. Just like that, a major competitor was gone. And here's the kicker. After the deal was done, Amazon quietly scaled back a lot of those deep discounts it used to conquer the market in the first place. All right, the next big issue that gets raised is this really fundamental conflict of interest. Because Amazon isn't just a store, right? It's also the entire mall. So what happens when the guy who owns the mall is also your number one competitor? So here's how it works. You've got millions of small businesses that set up shop on Amazon's marketplace. It gives them access to this huge customer base. But in return, Amazon gets something incredibly valuable, a perfect, real-time fire hose of data on what's selling, what's hot, and what's not. The allegation is that Amazon then takes that data, sees the most successful products, and launches its own copycat versions, turning its sellers' hard work into a free R&D lab for itself. So, all of this has sparked this massive debate. Are the old rules of the game even equipped to handle the digital age? Or do we need a whole new playbook? The analysis that kicked off this conversation lays out two potential paths forward. The first is to basically dust off our old antitrust laws and give them new teeth. That would mean shifting the focus back to market structure and making it easier to challenge things like predatory pricing. The second path is way more radical. Treat Amazon like a public utility, like the power grid or the railroads. This idea accepts that it's dominant, but says because it's now essential infrastructure, it has to be regulated to make sure everyone gets fair access. Okay, so we've covered a lot. What are the big takeaways here? What should we walk away with? Let's just boil it right down. First, Amazon's success isn't an accident. It's built on a genuinely powerful customer-first strategy. But the legal system we have today prioritizes low prices above almost everything else, not the long-term health of the market. And this has opened the door for huge platforms to use strategies that might really hurt competition down the road. Which leaves us at this huge crossroads. Do we fix the old laws, or do we need to write brand new rules for this new economy? And all of this really leaves us with one huge lingering question for our modern economy. We get these incredible, undeniable benefits: convenience, selection, and low prices, all delivered right to our door. But we have to start asking ourselves, what is the true long-term price we might be paying for all of it?